Hi everyone, we are Team 59 in Group B. The topic of our research is the relationship between advertising investment and sales. Let's take a quick look at the table of the contents and then we get started.
This project aims to explore whether advertising investment truly drives sustainable sales growth. In today's competitive market, companies invest heavily in advertising, yet results vary by industry, brand, and platform. We use data analysis to investigate how advertised budget, channel duration, and conversion efficiency impact sales. The data used in this study comes from public data sites on Kaggle. The advertising industry has shifted to a data-driven optimization area. Metrics like ROAS and log ROAS are used to assess advertising effectiveness and distinguish between high and low return investments. Platforms such as TV, social media, and newspapers differ in conversion efficiency and marginal benefits. Additionally, the duration of the advertise and its relevance to the target audience play crucial roles in determining its effectiveness. Despite its values, advertising returns vary greatly. This study addresses 5 key questions. Is there a significant correlation between advertising spending and sales? Do channels differ in efficiency? Do duration affect immediate or delayed conversion? Is there a direct link between advertising cost and conversion rate? And why do brands differ structurally in advertising performance? These questions directly impact how firms allocate resources and design advertising strategies. The objects of this study are to verify the linear link between advertising budget and sales, to compare efficiency across advertised channels, to analyze if advertised cost impacts ROI, to explore both short and long-term effects of advertising, and to identify structural brand differences use ROAS. These goals help build a data-driven foundation for optimizing advertising strategies.
Now we'll move on to the fourth chapter, data visualization and analysis. In the section, we will analyze the relationship between advertising investment and sales through visual charts. Firstly, from scatter plot on this page, there is a clear positive correlation between advertising investment and sales. The slope of the trend line in the graph is positive, and most of the data points are concentrated around the trend line, indicating a good regression fit. The R-squared value is 0.76, which means that advertising expenditure can explain approximately 76% of the sales fluctuations, demonstrating a highly significant correlation in business analysis. This also verifies the marginal effect of advertising. The more you spend, the stronger the ability to drive sales. The following is an analysis of different advertising channels. We can see that the regression trend line slope of TV advertising is relatively large, and the data points are also relatively concentrated, with a R-squared value of 0.61. indicating that its role in driving sales is significant. The dual advantages of sound and image in TV advertising combined with its wide coverage make it an important tool for marketing mass products. In contrast, radio advertising also has a positive relationship with sales, but the slope of the trend line is smaller, with an ad-scored value of only 0.33, indicating that its ability to drive sales is relatively limited. This page further demonstrates the effect of newspaper advertisements. The chart shows that its trend line is almost horizontal and ad-scored is close to 0, indicating that in the current media environment, newspaper advertisements have little significant effect on sales. This might be due to factors such as an aging audience and a single form of information presentation. Additionally, the pie chart on the right shows that television advertisements contribute 71.37% of sales, far exceeding radio 13.06% and newspapers 15.57%. This once again indicates that television is the most effective traditional advertising channel at present, and enterprises should give it priority in budget allocation.
This question explores whether spending more on ads leads to better conversion outcomes. Advertising cost does matter, but not always positively. Email is cheap yet performs poorly. Facebook converts well but has limited reach. Google Ads and websites strike the best balance. Solid clicks, reasonable cost, and high ROAS, so they should be prioritized in planning. This section looks deeper. Does more traffic really mean better performance? Not always. Email gets the most clicks but converts poorly, showing weak targeting. Facebook has low traffic due to platform limits, so instead of chasing volume, invest in effective, well-matched channels. Here, we assess how long an ad runs and how that affects results. Email performs best at 16 days. Facebook peaks early, then drops. Google Ads and Instagram are more stable. Short campaigns bring consistent results, while longer ones may vary. This question asks whether longer campaigns drive more conversions overall. Yes, 13 to 16-day campaigns outperform short ones. They enable multi-channel synergy. In contrast, short campaigns are fast but limited in impact. Finally, based on all findings, here are practical takeaways. Use 15 to 13 days as your base cycle. Match duration to channel traits. Plan the platform strategically, and most importantly, track data in real time to refine timing, content, and targeting.
Question 5. Is there a lag in advertising returns? Are there structural differences in advertising efficiency across brands? First, we use DEX functions to delay the advertising revenue by 1 month from Figure 2, compared with the monthly income and investment shown in Figure 1. The return rate of Figure 2, which is delayed by 1 month, is significantly higher than that of Figure 1, based on the investment at the same time point, indicating that there is a lag effect in advertising investment. Second, we can clearly see from these two figures that brand C and brand E has the highest ROI. Brand D is in the middle, and brand A and brand B have the worst. The ROI of the 5 brands is not random, but due to certain structural differences in advertising strategy, brand influence, or market matching. The trend line in the figure shows that there is a clear stratification phenomenon in advertising efficiency. High-efficiency brands are strongly leaning in two dimensions, while low-efficiency brands are always lagging behind. This structural difference reminds me us that the advertising efficiency among brands is not formed by chance, but reflects the comprehensive differences in the brand's overall market strategy, advertising content quality, and audience responsibility. Based on the question 5, we make the following conclusions. First, prioritize high-return channels based on the historical ROAS data. Prioritize budget allocation to efficient brands or platforms. Second, consider the lag effect of advertising. It is recommended to observe sales performance within 1 or 2 months after the advertisement is launched to evaluate the effect. Third, monitor and adjust regularly. Create a data visualization dashboard to dynamically track changes in advertising return rates. Fourth, optimize ad content and user experience to improve the quality of ad creative and conversation paths. Based on the entire study, we make the following conclusions. First, TV advertising is the most effective of the 3 traditional media and should be prioritized in terms of advertising budget allocation. Second, digital advertising channels have a balanced performance in terms of clicks, cost control, and conversation rate, and are the core promotion platforms. Third, the length of advertising has a significant impact on the conversation rate, and it is recommended to prioritize the strategic cycle of 15 to 30 days. Fourth, there are structural differences between brands in terms of advertising return efficiency, indicating that enterprises should formulate differentiated investment plans according to brands. Finally, there are references. If you are interested in this study, you can read these references in depth. This is the end of the speech. Thank you for your watching.